Good evening. So my name is Jaap Bos. I'm an associate professor of finance at the, hang on a sec, at the finance department here in Maastricht. And I'm here to talk about banks and the crisis. So my first thought when I was asked to give this talk was something related to being overwhelmed, because that's a big topic, the crisis and banks. So I am not going to, I'm certainly not going to be able to cover all the ground that is necessary for you to understand banks and the crisis, or to understand as much as I hopefully understand about banks and the crisis. But we're going to try to, I'm going to try to make it interesting and fun tonight. So when I think about banks and the crisis, and I'm sure it's the same for you, initially we start to think about negative things, right? So the banks have not exactly played the role of firemen and policemen during the crisis. If anything, they're supposed to be the crooks. So we think of having too many big banks, offering weird products that people should never have bought, and promising returns that they could never realize, and everybody fell for it. So I think the main thing that I'm going to try to do with you tonight is understand a little bit better about sort of what banks are, what they do, and whether it makes sense that they are what they are right now. So whether economically speaking, they should be as big, as diversified, as dominant as they should be, and what that implies and what we can do about it. If you have any questions during the talk, just raise your hands. Otherwise, if you prefer that, at the end, I'll make sure that we have some time for some questions as well. So I want to start with a small story. So, story of two friends. This is one of them. Hope you can see him, and he's they're cycling. Anybody has any idea where this is? Got a tip for you. It's pretty cold, even in summer. Finland. I heard it already. Iceland, exactly. So they're biking in Iceland, and in case you don't know, Iceland's pretty interesting. So the capital houses about half of the people, 150,000 approximately, and the other 150,000 are spread across an area which is about 3 to 4 times the Netherlands. So needless to say, certainly for these Dutch guys, it's a pretty deserted place. And they're in some small village, just shopping for supplies, and then one of them turns to the other and says, "Hey, I saw something funny in the window next to the supermarket." And the other one says, "Well, what did you see?" And he said, "Well, the people here seem to be actually buying a mortgage where their mortgage payments are in Japanese yen. Do you think that makes any sense?" The other one says, "I don't know, that seems weird to me." And then they arrive in Reykjavik and they see all these banks. And they're pretty impressed by that. And but at the same time very surprised, because 150,000 people, all these banks in Iceland, why do you need all these banks? And then they see the interest rates that you can get on a savings account if you put your money in an Icelandic bank. They're even more impressed, but they also become more and more suspicious. So remember what I said, strange products, a lot of banks, very big, returns that you have to ask yourself, can they really keep their promise? So a few years go by after their trip, and then Landsbanki, one of those banks in Iceland, falls. And the one friend who was asking the questions at the time, he says, I'm not surprised, because, you know, remember what we saw on the trip in Iceland? And the other one says, it's such a hassle. And the first friend says, but why is it such a hassle? Well, I got to fill in these forms because I want my money back. You want your money back? What do you mean? Yeah, I put money in a savings account in one of these Icelandic banks. but how could you do this? The first friend says, we were there, and you saw what was going on there, so you were not ignorant. How could you do this? Yeah, I figured, how hard can it be? How difficult can it be? Surely it must be okay. Plus, I don't see why you give me such a hard time, because all I have to do is fill in this form and I get my money back. Which one of the friends is right? I don't know. Let's see. So, we're going to talk today a little bit about banks and the crisis. And we're going to talk about those banks. And when you hear me talk about those banks, keep in mind that example of these high interest rates, these strange products, and these big banks in Iceland. But you can also fill in Netherlands or Germany or Belgium or pretty much anywhere where you're from. So I want to start with a small motto, small but important. So this is something that I've always said since the crisis started. If anyone, including me, claims to be able to explain the crisis, do not believe that person. I don't think that there's a single explanation, and I have yet to find the person who can tell the story about the crisis. I'm going to mention two people at the end of this lecture who I think have made a very, very interesting contribution to understanding what has been going on, and also have come up with some interesting suggestions. But for now, as the picture says, memento, remember the motto. So, a big disclaimer. Take what I say also with a little bit of a grain of salt. So let's start then. So what are we talking about today? We're talking about banks. So we have a simple example of a bank. I put here a dollar sign, but I could have also included that yen or euro or maybe all three of them. So what has happened to your average bank in the last 20 to 30 years? So for quite a few of you, I think 30 years is before you were born, so you're going to have to trust me on this a little bit, and otherwise ask the other people with less hair or gray hair in the room. But we don't have to go back that far. Even 20 years is more than enough, as I'll show later. So what happened was that small bank, first of all, became really big. It became a much bigger bank. That's the first thing. The second thing that happened is that it became much more complex. It literally started adding pillars. So it used to be a bank that had deposits coming in on one end, and then it was giving out loans on the other side. And now it's starting to offer insurance products. It starts to do brokerage services. You can get all kinds of different products from this bank. So it's become more and more complex. It's also become more and more global. Now it's operating on different continents and in different countries, and it's taking over other banks, and it's just becoming a complex, bigger, global bank. And it's starting to compete with other types of financial institutions, insurance companies, investment banks, the types of banks that actually help bring companies to the stock market, for example. So the type of companies that it traditionally used to not compete with, but now it starts to compete with them. And then finally, it also starts to operate in an environment which actually changes quite a bit in the last 20 or 30 years. And I'm going to talk later on about two kinds of changes. One I'm going to refer to, perhaps a little bit wrongly, as income inequality. So I'm going to be talking about basically the gap in not just income, but also in productivity, education within countries, whether that is the US, the Netherlands, or any other actually developed country. I'm also going to talk a little bit about developing countries, but mainly developed countries. And then the second thing is financial inequality. Why is financial inequality not the same thing as income inequality? Because what I mean with financial inequality, I mean the financial development of a country. So if you look at a country, does it have a big stock market? Does it have a solid financial system? Can you issue debt there? So can you actually go to the market and get, for example, money by issuing a bond, in Dutch obligatie? So these types of things. Is it a well-developed financial system? I'm going to be talking about these two things as well. So you see that there's a lot of stuff that's been going on. So we started actually in a very, very simple way with this small bank that is basically still the core of a lot of textbooks in economics and in finance when we come to banks. The intermediary that takes in loans, in deposits and hands out loans. And then we move to something much, much different. It's bigger, it's more complex, it's global, it's interacting with all kinds of other financial institutions, and also it's operating in a changing world. And what we want to know is, what has been the effect of this? Does this make economic sense? and what is the impact of this? And I'm going to focus especially on the first question. So economically speaking, does this make sense? So can we expect, should we have expected this based on what we know about how a bank actually functions? So we have, in a sense, a whole new banking world. And what has happened is that banks have become bigger. They're no longer just intermediaries. They've become global. They compete with other financial institutions. They have new technologies as well. So this may sound strange to you, but things like even ATMs, but let alone things like internet banking or internet brokerage services, they're all relatively new. And they didn't exist 10, 20, certainly 30 years ago. There have been regulatory changes as well. Does anybody here know what Basel II and Basel III are? Yeah? Yeah. So Basel, it's named Basel in after Basel in Switzerland because Basel houses the Bank for International Settlements, which is basically, think of it as the central bank of central banks. It's the clearinghouse where all of these central banks that are exchanging money with each other and are trying to sell and buy currencies and sometimes other things, they do this through this clearinghouse. But the Bank for International Settlements in the last 20 years has become much more famous for something else, which is the Basel Accord. And the Basel Accord, or the Basel Accords, I should say, because there are three, are aimed at making the banking system safer. And the main way that they do this is by making banks safer. As we will see later, that's not necessarily the same thing, but they focus on making individual banks safer. And what they do is they impose all kinds of rules on banks on how much money they need to keep in store, how they should assess your riskiness if you apply for a mortgage or for a student loan, what kind of interest rate that you should charge, what you should do if, what the bank should do if you no longer are able to pay your loan, all these types of different things. So they basically comprise of a set of rules that dictate how a bank should run, especially its risk management, but in essence a lot of its activities. And this set of rules has expanded enormously in the last 20 years in an effort actually to keep up with all of the changes that we just saw. Now, I'm not going to talk in detail about these regulatory changes, mainly because that's a whole other lecture. But keep in mind that besides all of the stuff that I'm going to be talking about, all of the rules of the game basically have changed drastically as well in the last 20 years. And then lastly, as I talked about a little bit already, there are these structural changes in the economy. The rise of China, the rise of India, the decrease in international diversification opportunities. So another thing to keep in mind as I start talking about banks and about investments and about loans and about their international activities is that as the world has changed, ironically enough, it's also become much, much more similar. So if you think about pension funds, if you think in the Netherlands about a pension fund like APG, it used to be the discussion, how much can a pension fund invest in stocks rather than just in bonds? And why would it invest in stocks? Everybody always says, this is what sort of the mainstream media would let you believe. It's because you can get a higher return. You can earn more money. They're more profitable than bonds. Sure, but as economists like to say, there's no free lunch. So where there's a higher return, there's also higher risk. So there's another reason of why we were debating 20 years ago about whether pension funds should be able to invest more in stocks. It's because there's a diversification gain. And diversification, the principle is very, very simple. We have diversification gains if when one thing moves in one way, another thing moves in a completely other way. So in other words, if the price of bonds goes up and then the price of stocks goes down, that's great if I'm investing. Why? Because that means that if I invest in stocks, in bonds, but I also invest a little bit in stocks, then if the price of bonds goes down, I have a little bit of insurance because the price of stocks will go up, and vice versa. Think of your communicating vessels that you learned in your physics class, right? So it's that idea of what a statistician or an applied economist or finance person would call imperfect correlation. Correlation that's less than 1. They're not perfectly correlated. They don't co-move exactly in the same way. And that's great. And finance experts, including these banks in this whole new banking world, are constantly looking for these opportunities. How can I diversify? How can I actually spread my risk, right? But the funny thing is, as the world has developed and as all of these things have been going on, diversification gains, diversification opportunities are less and less in existence. So if you look at all of the stock markets in the world right now, and you look at the correlation of the stock prices globally, so correlation is typically expressed between 0 or 1, or -1 and 1, where 1 is perfectly correlated. Well, guess what? That correlation in these stock prices in the world, if you measure it over a long period, it's about 0.99. So there is hardly any diversification gains if you just invest in stocks. And correlation between stocks and bonds is also a lot higher than 20 years ago when we were talking to APG about should you be investing more in stocks. So if you ever wonder, last year I gave a talk in the Studium Generale about investing in commodities. So why do pension funds and banks invest in coffee and cacao and gold and oil? And one of the explanations that I gave at that time is because at least when they started doing this, there were still some diversification gains there. We had the TFAF here in Maastricht. There were a lot of investment bankers walking around there as well. Why would an investment banker invest in art? It's a very risky investment. It's highly illiquid. It's very difficult to determine the value of a piece of art, so why would they do this? Because, hey, art prices are not very well correlated with the stock market. And I would add to that, yet. Because what you see is the more integrated the world becomes, the more all of these things start moving in the same direction. And when you start to talk to an economist about a crisis, remember the disclaimer that I started with, right? I said, don't believe anybody who tells you that they can explain the crisis. So keep that in mind with what I'm going to say now. My personal explanation when somebody says, what is a crisis? What is an economic crisis or a financial crisis? Is very simple. It tends to be when those correlations go to 1. When all of the diversification gains, all of those risk-spreading things are gone. And what causes that? There can be all kinds of different causes. And if you look at the crises that existed in the last 300 years, you will see that the causes tend to differ. But the phenomenon itself is very, very steady. It's when all of the stocks in the stock market go, and they go down at the same time, all over the place, and then not just stocks go down, but then housing prices start to go down, and all kinds of things that are all representative of the wealth that we have all start to move in the same direction, and usually it's the wrong direction. And then we call it a crisis. So part of what has driven this change in this banking world is actually related to that phenomenon. And I'll come back to that as we go along, but keep it in mind for now. So in the old days, it was very simple. So when I was a student and learning about banks, we said, I remember the textbook, it said a bank is an intermediary between depositors and borrowers. And there are lots of depositors, and they all put a little bit of money in their bank account. And the nice thing about your bank account is that assuming that you're not in the red, so most of your students, it's the middle of the month, hopefully you're not in the red yet, you can go to your ATM and you can actually withdraw money from the ATM. And that's nice. And in the Netherlands, if you're lucky, you also get even some interest on that money that is in your checking account. Why would a bank be willing to do that? Well, because it has a lot of borrowers, fewer than the depositors typically, because borrowers want a little bit more money to borrow than the money that you have in your checking account at any given point in time. And they want to borrow money. But they typically don't want the bank to come at any given point and say, and now I want my money back, right? If you get your student loan, you really would be upset if, at any given moment, the bank would say, and now I want it back. So you have these depositors that really value liquidity and have these small amounts and they put it in the bank. And then we have these borrowers, and they value liquidity a lot less. They want money for quite some time. They want a larger amount. And that's nice because we have sort of a marketplace where we bring all of those things together, and we call that marketplace a bank. And because all of those different depositors all put their money in the bank, but they cannot all spend enough time to monitor the bank and make sure that the bank doesn't do anything crazy with its money, the banking sector is a little bit different from other sectors that we're talking about, whether it's construction or ice cream or whatever you want to think about. And we say, well, then maybe we should have actually some kind of institution that also, acts on behalf of those depositors and make sure that everything stays more or less okay. And then we have a supervisor, which in most countries is a central bank. And that's the idea of a bank. That's a traditional idea of a bank. There are many banks in this traditional idea as well. So in every little place where you would go, there would be a local bank. Relationship banking is a dominant business model. So if you went for a loan to the bank, whether you had gotten a loan from the bank before and repaid it mattered. Maybe also whether your father or mother had taken a loan from the bank before and repaid it mattered. And also who you worked for, where you came from, how long you knew the banker, all kinds of things. That is maybe soft information, but not unimportant. It played a role in whether you got a loan, yes or no, and under what conditions. Risk was largely local. So one of the things that, that I think is interesting about this crisis is related to this. So let me try to explain it. So one of the things that that people immediately started shouting, basically, when the crisis started, was derivatives. Now, I'm not sure if you've ever heard of that word, so let me try to explain it. So, what has happened in the last 20 years is that there's been a whole new business developed by banks, for banks, and other financial institutions and investors. And what a bank does is the following. So let's say that I'm a bank, and I take a loan from you, and from you, and from you, and from you, and then I have these loans, and they're on my balance sheet. And then I cannot take a loan anymore, because I only have so much deposits, and I have all these loans, and they're all in Maastricht, so if the Maastricht economy tanks, then I'm in trouble, and they're on my balance sheet. But what I can try to do is, I say, let me start a little company, I call it Jaap 2, and I sell these loans to that company. So now they're no longer on my balance sheet. And then what I do is I say to all of you here, if you want to, you can buy shares in that company. Because of course I need to fund that company as well, right? Otherwise, how can that company buy the loans from me? So I sell shares in that company to you. You all own a share now of their loans. We call that securitization. And it's one of the big things that has been investigated because of the crisis. Well, why am I mentioning this in this context of risk being largely local? Securitization is now being seen as one of the evil things that has helped cause the crisis, etc. Because what it means is that now I can just make loans and I just sell them off and they're no longer my loans, even though really they are, and I don't feel responsible for them anymore, and you buy them and you don't know how risky they are, and there's all kinds of problems with them. But in 1929, when we had a big crisis, securitization was actually seen as one of the things that would make the whole banking system safer. Because at the time, in the US, central bank said, and I think, to be fair, with good reason, yeah, but hang on, one of the problems that we are having is that we have this bank in New York, and it only makes loans to New York people, and we have this bank in California, and it only makes loans to people in California. And wouldn't it be nice if the bank in New York could also have a little bit of the loans of the bank in California, and vice versa? Because remember, spreading risk, then they spread their risk a little bit. It's a very good example of something that was originally intended to help reduce the risk in the system, but in the end, when used in the wrong way, contributed to the downfall in the system in the most recent big crisis. But originally, like I said, risk was largely local. So, the picture I like to show was of the Savings Bank Museum. This is in Scotland. If you ever want to visit it, it's fantastic. Why? Because the kind of bank that I'm describing here would be, if you're a Dutch person, would be something that you would have in mind is your old local Rabobank, or if you're German, your old Raiffeisenbank, or something like that. Something which, according to a lot of people now, sort of would belong in a museum. So how has banking changed? Let's talk about that a little bit. So I'm going to talk about a couple of things, and at the end of the presentation, I'll give you a website, my website, where you can find basically all the background information if you want this. I'm a scientist, so I need to actually show you also that I'm not making this kind of stuff up. But unless I say it otherwise, it's based on my own research in the last 15 years, basically. So let's talk about size. There's a lot of evidence, and I would say, personally say, an overwhelming amount of evidence that in banking we have what is called an U-shaped average cost curve. And what does that mean? It's very simple. If I have size and I have the average cost, let's say, of making €1 of a loan, then initially as the size increases, the average cost decreases, and then as the size increases, the average cost increases. U-shaped average cost curve. Very simple. But it has a big implication, because if I have a U-shaped average cost curve, that means that there's an optimal size. That means that there's one point where the average costs are the lowest, and if I become bigger than that point, my costs are increasing. And that matters, because if I'm the borrower who wants to get a loan from this bank, and that bank is too big, then that bank has to charge me a higher interest rate because I'm now too big. So if indeed we trust this research, including my own, that says that there's a U-shaped average cost curve in banking, then we have to wonder, hey, but for those banks that are bigger than this optimal point, why are they doing this? From a cost perspective at least, it doesn't make sense. So that's the first sort of red flag, something that we have to think about. And most banks by now, I'll show you an example in a second, are much bigger actually than this optimal size. So purely from a cost perspective, we cannot explain why banks need to be that big. So this actually is a puzzle in a way. So I'm going to show you an example. This example is based on a study that I did with an American professor, Jim Collari, and Ryan van Lamoen, a Dutch PhD student of mine, and it's for the US. But I could make the exact same drawing for Europe or for the Netherlands in particular, and you would see the same picture. And like it says here, 1993, so I'm going to show you a little movie. And watch what happens in the movie. I'll explain it before I show it. And keep in mind the year 1993. Why? Because 1993 is the year where in this movie, most banks, actually by far most banks, have moved beyond that optimum point. They're now too big. So what we're going to look at is this. So let's look at this for a second. So there's three pieces of information in this graph. On the horizontal axis is size. It's total assets. It's the length of the balance sheet of these banks. How big are they? And I've just bucketed them in 10 groups, from small to big. Yeah? And the size classes are the same over the period I'm going to show you. So I'm going to show you 21 years of data, but the size classes stay the same. So big in 1984 is also big in 2004. Yeah? So it's not that the definition of big changes. So that's on the horizontal axis. On the vertical axis, very simple, the number of banks in that particular group, in that bucket. So for example, in 1984 in the US, the smallest banks, we had almost 3,000 of them. Yeah? And then the one that's maybe the most difficult to understand, which is the size of these circles. So the size of these circles is the markup, the average markup. It's the relative markup of these banks. What is a markup? It's very simple. Remember what I said about these costs. And I said, hey, but if the bank has higher average costs per euro of loans, then I have to pay a higher interest rate. Well, the markup is exactly that. It's the difference between the price and the cost. Right? So the bigger this difference is, think of when you go and you buy a cup of coffee. And it costs coffee lovers, I don't know, $1.50 to produce, and you pay $2.25. then the markup in absolute numbers is 75 cents, and as a percentage is 75 over 225. Right? That's the percentage profit, the profit margin of the banks. So what these circles here show is the relative profit margin of these banks. And what you can see is that in 1984 we had a lot of small banks. We had actually no, if you look at here, we had no really, really large banks yet. And yes, there was these really small banks, and also these, they had a relatively small circle, so they were not super profitable, but other than that, no major differences yet. So now let's see what happens over time. So what we see is now we move to 1985, we move to 1986, and what you see is that gradually the number of banks starts to drop, the number of small banks, and the number of large banks starts to increase. That's the first thing that you start to notice. And you see also we're only in 1989 that it goes actually pretty rapidly. So this is a drastic change in an industry. Think about how many mergers are behind this. We're about to reach 1993, and in 1993, remember, boom, now banks are becoming too big. So, in other words, any increase in these bubble sizes, their markups, can no longer be explained by a drop in their costs, because they're actually above their minimum cost point. But look at what happens to the size of the bubbles. So you can see that the size of the bubbles, it just keeps going on and on. So even though these banks have moved beyond their minimum efficient sizes, economists would call it, right? They're no longer actually exploiting any cost differences. Their profitability just keeps going up and up and up. And what we end up with in 2004 is a situation where there's hardly any small bank left. I mean, at least it's very small. Oh. And we have a lot of large banks which make huge profits. So you see, when people start talking about a drastic change in the banking sector, this is what they have in mind. A huge change in an industry. There's not many industries actually that have gone through a change like this. One that comes to mind, as I say this, is kind of funny, newspapers. Except there's one big difference with newspapers. Who knows what it is? Exactly. They wish they had these bubbles. They don't have them. So it's a huge change. Now, the tricky thing is that whenever something like this happens, and whenever as an economist or as an interested viewer, you become critical of this and say, yeah, but is this good? And you know, what would happen? You know, should it not have happened? Well, the tricky thing is that we typically have a lack of counterfactual. Right? As economists, we don't work in a lab. We cannot say, well, let's just turn back time and see what would have happened if, you know, we don't know. So in a recent study that I did with two former students of mine who are in Ghent, we looked at this. And again, what we're going to show you now is for the American banking sector, but I suspect that we would find the same if we did this for Europe. So what we did is we asked a question and said, well, what would happen to the riskiness of the banking system if we actually reduce the size of these big banks? So let me give you an intuition for it. So this is the intuition that I give to finance people when I present this at a conference, because they look at this very funny. They say, what kind of exercise are you doing? And I say to them, well, if you're an investor, let's say that you are a pension fund, would you invest in a fund that consisted 80% Facebook shares and 20% everything else? And they say, no, of course not, because that's not spreading my risk, and that's a portfolio that, by definition, is too risky, and I would spread it more, and I would hold smaller shares of other banks, etc., of other companies, etc. And I say, yeah, but if you're a society or a central bank or a country, or you know, think of the US in this case, you are in a way holding a portfolio that, remember the video that you just saw, just became way more concentrated. It's much more than that example of 80% Facebook and 20% the rest now than in 1984. So what would happen if you started to rebalance that portfolio? What would happen if you actually try to find out if you can make it safer? So in other words, is the size of these individual banks, is that related to how risky the system is? So what would happen if we got rid of the large banks? Do we have to give up profits? That's one of the things that people are always afraid of. Yeah, but you know, then they become not profitable enough again. And banks that are not profitable are also risky, because if they don't make any profits, then they can go bankrupt. Okay, That's fair. Let's look at what happens. What about risk? Can we really lower the risk if we lower the share of these large banks? No, because then other banks will just become large, and it doesn't lower the riskiness of the system at all. Okay. How would the banking landscape change? So what would happen? Think of that movie that I showed. Would it really be very different if we try to actually minimize the risk in the portfolio a little bit? And if it did, what's then so different about these large banks, about the banks that are currently so large? Is there something that makes them special? So let's find out. So what we did is we did this huge exercise. Fortunately, Ghent University has one of these super fast mega computers that allows us to do all these calculations and get results that are reliable, at least that we think are reliable. And the first question we ask is, do we have to give up average returns? In other words, do we have a banking sector that is significantly less profitable if we do this? And what you actually see is that this is not at all the case. So the straight line that you see here is what economists would call the MVP, or the minimum variance portfolio. In other words, it's the counterfactual. It's a situation where we said, okay, let's try to actually find the optimal share of each individual bank so that we have the best group of banks. And the dotted line, which we call Fed here, is actually the actual banking system in the US over this period. So you see 89, nice crisis, you see the current crisis. But what you see is that on average, the profitability is in percentages of the sector. It's not lower if we do this. If anything, it's higher because we don't have these huge dips. So the first worry of a lot of people in saying like, no, you should not do this because then you destabilize the system because you kick out all the profitable banks. No, it's just not true. So, but okay, maybe that's because we're not really lowering risk. So what I'm going to show you now is basically think of this as relative risk. So I'm going to show you the riskiness of those two situations. The same thing, the straight line is our case, our counterfactual. The dotted line is the actual system. And in case you hadn't noticed it, here's the straight line. So what you should be looking at is the difference. And exactly here you see again, crisis, crisis. And we do all kinds of things to find out how realistic this is and how robust this is. And actually it's a very, very robust finding. So then we get to the third question. Remember, well, is this then really because of these banks that are currently so large? And are they so special? So what's going on here? So again, we do the same thing. Now I'm going to show you three lines. I'm going to show you the straight line, which is the share of the banks that are currently the 5% largest banks in the US, and what would their share be in this counterfactual. Then I'm going to show you their actual share in this dotted line, and I'm going to show you a third line, also dotted, that is the share of the biggest 5% banks in our counterfactual. So just to make sure that we're not swapping out large banks for large banks. Yeah? I'll repeat it when I show you this. So what we see here is we see the largest banks in reality. And what you see is that in the end, it's almost 80% of the total assets that are held in the American banking system that are in the hands of 5% of the banks. So think of that as an example that I gave, right? Pretty concentrated. If you try to create this counterfactual, that share of the 5% largest banks, not the same banks, mind you, but the 5% largest banks in this new situation drops to, well, here's a little bit of a peak, but other than that, it's below 20%. And the share, and there comes the interesting thing, of these banks that previously were so large, it actually drops to less than 10%. So this whole discussion about should we get rid of these large banks, let me put it this way, let me be a little bit careful. I think it actually is worthwhile having that discussion. Because purely from a system point of view, do we make the whole system safer? I think there's a lot to be said about it. But it may not be purely the size that matters. Because what's so different about these large banks? So that's what we were very curious about. We started looking into this, said, well, what's going on then? Remember what I said about intermediation. I take in deposits, I give out loans. Well, these large banks, they do way more things that are not related to that than other banks. So they have a lot of non-interest income. They make money from investing, they make money from consulting services, they do all kinds of things that are not related to loans and deposits. And that type of income, remember what I said about correlation and spreading risks? Well, as it happens, that type of income tends to move in the same direction much more than this interest income. Think of the example that I gave of the bank in California and the bank in New York. So what you see is that this is the type of income that starts to all move in the same direction, down at the same time, much faster than in any of the other traditional stuff. So that's why it explains why slimming these banks, making these banks a little bit smaller compared to the rest, actually matters so much for the overall picture, as I showed you. And the interesting thing is, one of the things that, of course, you could criticize us for saying, like, yeah, but what you're suggesting is drastic measures. Look at that, from 80% to 10%. Sure, but even if you do it a fraction of that, what we show, and I won't show you that here, but what we show in the research that we did is that even if you do it a fraction of that, the effects are already enormous. So, like I said, having a discussion about do we really, really need these large banks from a system point of view, making the banking system safer, is definitely something that's worth having, I think. Economists tend to talk not just about scale and size, but also about scope. Remember what I said, banks started offering money more products. They started to go into investments and into consulting services and into insurance and all these different types of things. So maybe that's where the advantage is. Maybe the bank has become so big not because it has this advantage in terms of size, because clearly it doesn't, but it has this advantage in terms of scope, synergies, right? Well, they have expanded their product mix, and also they've expanded their geographic scope. They're operating in many more different areas. And like I said, they started to compete with all these different types of financial institutions. So what do we know about scope? So in a study that I did with the same American professor that I mentioned earlier, we looked at this. And what we looked at is we basically went underneath the surface. And we said, so what does that mean, scope? In light of this increase in this product mix. What it means is, if I have scope economies, if I have synergies as a bank, that means that if I increase the amount of lending that I do, if I give out more loans, then the costs for me of doing investments or doing these consulting services drops. Because that's what synergies mean. Right? So if I do one thing, then another thing also becomes cheaper. But what we find is actually the opposite. So banks that do more lending, actually the cost of investing goes up, as well as the cost of these other services. All these things that are related to investment banking, essentially. So there's no scope economies there. There are scope economies, however, in a bank. Because if a bank increases the amount of investing it does, then what we find is that the cost of other services, so also these non-intermediation things, it does go down. So in other words, yes, there's scope economies in banking, but they're not at all related to the stuff that we care about, namely deposits and loans. They're actually related to all of these new things that are in the banks. So investments, brokerage services, and all these types of things related to fee income, so consulting, etc. So again, not a very strong argument in favor of these big banks. What about geographically? So I put up a quote from a paper that we did. And we said, actually originally, to be really honest, we were not even going to investigate this in this paper. But if you're a scientist and you go through a reviewing process when you try to publish your paper, and one of our reviewers who wrote a report on our paper said, you should look into this because we think this is very, very important. And I remember when I actually executed this research, I was a PhD student that got published a few years later. I remember the frustration of trying to look into this. Because not only was it an enormous amount of work to find out exactly what bank was operating where, but also, no matter what we did, we could not find the results that the reviewer asked for. Because the reviewer said, I'm sure that banks that are active in all these different areas, they are much more efficient than banks that are not. Let me read what it says here. It says, the results suggest that cost efficiency diminishes as banks move beyond their domestic geographic area. Profit efficiency, if you read the sentence again, that increases. So in other words, sure, we did find some evidence that banks became more profitable when they did this, but it was not because they were better at operating and minimizing their costs. Cost efficiency actually decreased. So it's the same kind of story, but then geographically, that I told you earlier about scale. Yes, they became bigger, but there was a point where we said, yeah, but now costs can no longer explain why they're getting bigger. And that matters. Remember that markup, right? If the costs are not going down and the banks are making more profit, then the only way that they can make more profit is the prices go up. So at least from a cost perspective, there's no reason, we didn't find, at least at the time, that there's a reason for banks to be so geographically expensive. So I said also that technology changed a lot. And technology in banking is it's an important topic, but it's also a really, really difficult topic because it's hard to grasp. So when economists talk about technology or innovation in banking, typically, or in general, we distinguish between product innovation and process innovation. So do I sell a new product that is innovative? Or do I execute an existing task in a new way? Process innovation. So we have product innovation, or perhaps increasing in transparency and moving around risk, as I'll explain in the next slide, and process innovation. So let's look at the two. And I'm going to start with product innovation. And I'm not going to cite my own research, but I'm going to sort of hopefully make you think a little bit. So try to think along. So product innovation in banking. So I think personally that a lot of product innovation in banking is not really innovation, at least not starting from scratch and really coming up with something new. What it is, it's a recombination of existing products. So who's not from the Netherlands here? All right, quite a few. So I'm gonna surprise you now, perhaps. So I don't think anymore, but there was quite some time when in the Netherlands you could get a mortgage and it would be called what Dutch people call an investment mortgage. So what would happen is that rather than paying off your mortgage every month, right, you pay interest and a little bit of the principal, what you would do is actually that instead of paying off the principal, you would put that money into an investment fund. And the idea was that by the end of your mortgage, so let's say 20, 30 years later, whatever the maturity of your mortgage was, the time of your mortgage, you would have enough money to pay back the original amount of the house. So let's say the house is worth 300,000 euros. You would have 300,000 euros and hopefully have some pocket change. So you became rich by taking a loan. How awesome is that? Right? Of course, it's also kind of tricky because the stock market can also go down. And what do you do if 20 years from now or 30 years from now you have 250,000 euros in an investment fund and not 300,000 euros? Then the bank will say, guess what? You need to pay 50,000 euros out of pocket. So it's an interesting product, but it was quite popular for quite some time in the Netherlands. And a lot of people considered it at the time, and maybe still actually, as a product innovation. I'm not sure if I would really consider it a hardcore product innovation, because like I said, it's mainly a recombination of existing products. And if you find ever that a financial institution offers you a product which is a combination of existing products, it's not necessarily a bad offer. I think personally that the investment mortgage is not something I would take, but that's personal preference. But in any case, if you get offered a product like that, you always have to ask yourself, can I also do that myself? right? With a lot of financial products, you think, well, if you offer me this and this, if you take a checking account with us, you can also get your insurance. Yeah, sure, but I can also just get my insurance somewhere else. And why do I need to combine that necessarily? Unless you make me a huge deal that I'm way better off, but like I said earlier, there's no free lunch. So always be a little bit skeptical if this happens. It may reduce risk. So it may be that the bank offers you a product that is really for you is much more attractive. But risk is something that a lot of people have a lot of difficulties dealing with. Are you familiar with TED Talks? Yeah? There's a TED Talk, I forgot actually exactly who gave it, but if you Google the right words, so listen to what I'm going to say now, and if you Google the right words, then you will totally find it. It's by this high school teacher in the US, and it's about the importance of statistics. And the argument that he makes, if I can paraphrase him, is he says, well, if there's one thing that the crisis shows, it's that in high school we teach too much math and not enough statistics. Because, and this is a joke as an economist I used to make about accountants, we used to say the problem with accountants is that they can add and subtract, they can't multiply and divide. And why do economists make that joke? Because it's, some of you are laughing, but why do you make that joke? Because risk management is often about multiplication and division, right? Rarely do you add simply things. Why? Because you have these diversification gains, remember? So you cannot just add things. The risk of one and the risk of two is not necessarily the sum of the two, because hey, maybe they move in slightly different directions. So the point that this person who gave this TED Talk makes is he said, well, one of the things that the crisis has shown is that people do not understand risk well enough. And we need to educate them. It's not so important whether they can solve integrals, in mathematics. It's much more important that they actually understand what their bank means when it says, hey, this investment product that I'm selling you, it's a high-risk product. That they understand that that implies that there's volatility and that the returns can go very far in one direction and very far in another direction, and what that means and what probabilities are and all these types of things. Regardless, product innovations may actually help you reduce risk, but, and then it comes back to the lessons about risk, if it reduces risk for you, you should always remember two things. First of all, that risk is not gone. It just means that you've sold the risk to somebody else. So first of all, from a system point of view, from a financial system point of view, you haven't necessarily reduced the risk in the system. You have now less risk, but somebody else has it now. So from a system point of view, the risk is not gone. Secondly, risk management and a business of banking is all about pricing risk. So it's not so much a matter of whether you have now reduced the risk, yes or no. It's whether you have sold the risk and paid the right price for doing so. It's just like an insurance product. When you buy an insurance product, you're also selling risk. You say, I don't want to have the risk of being liable for damage that I may cause, so I get liability insurance. Well, how high do you think this risk is? And are you willing to pay the price for it? Is it fairly priced, yes or no? If it's not, it's risky, pun intended. So just that the idea that a bank sells you a product and says it will reduce risks, well, it can be good or it can be bad. It all depends on how important is that risk for you and is it priced correctly. And for the whole financial system, like I said, it doesn't mean that the risk is gone. It's just somewhere else now. So last thing before the break, let me say something then about the other type of innovation, process innovation. So I talked a lot about scale. Remember, as banks become bigger, do their average costs decline, or do they then eventually go up again? Scope economies, doesn't matter what my product mix is. But maybe something else has happened in that picture that I've shown you. Remember, or in the movie that I've shown you. Maybe in the period 1984-2004, the banking technology just changed. And the way that banks are able to produce and the location of that U-shaped average cost curve, all of those things have shifted. So we have a shift and things are just totally different. So we started looking into this, and we started looking into this process innovation. And in particular, what we started to do is follow a research line which was started by some people out of Harvard, where they look at the relationship between innovation and competition. And they'd written a couple of papers on manufacturing industries, where they found that there's a inverse U relationship. So if there's a lot of competition, basically firms want to innovate, but they can't because they don't have any money, because it's cutthroat competition. And if there's no competition, firms are rich and they have a lot of money, but why would they innovate? Because they're doing fine as it is. So there's an optimum point of competition where optimum level of competition where innovation is maximized, where we get a lot of innovation. In other words, if you want a bank to offer you a better interest rate tomorrow than it does today, simply because it can, because it has managed to lower its cost because it's more innovative, then that's great. And what needs to happen to the level of competition in order for that to be the case? So in the first paper that we did on this topic, we looked at this movie. And we said, what happened after 1993? So is it indeed the case that the banking sector has gone beyond the optimum point, also from a competition point of view? So do we see that the banking sector as a whole has become less innovative because there's not enough competition anymore? And we found that that was the case. In the second paper that we did, we found something much more interesting, because we started thinking about this. So what happens typically if I'm innovative and I do something new? If I do something new, then I increase my share of the market. I become bigger. I expand at the cost of you and you, because you didn't do something new. So now I'm bigger and you're smaller. But wait a second. Banks had moved beyond this optimum point. Remember? This point where the average costs were the lowest. So now I innovate and I get the rents, the money from innovating, because I'm first and I capture your market share and I get that extra money. So that's great. That makes me want to innovate as well. But by doing so, I become even bigger and I'm already beyond my optimal point. So I lose some of the money because now my costs go up again. So we have these two things that act in the opposite direction, right? Innovation helps me escape competition, right? I don't have to compete with you because now I've innovated and I'm better. But on the other hand, innovation makes me bigger, and bigger means fatter, lower, higher average cost, not as lean and as optimal as I was before. So which one of the two outweighs the other one? So here's one of the results that we found. So the straight line is the banks that are still relatively small. And the dotted line is the banks that are relatively big. And what you see is that for both banks, this is in the same market, this is again for the US, based on the same results that we saw earlier, we see this inverted U. So that means that if you look at it, so this is very little competition, this is a lot of competition, and what you see is that there's an optimum point, where you say, now it's good. So what this suggests, I'll translate it to you in economic terms, is that you need to allow banks to make a little bit of profit, because then they have enough money to innovate and do a better job next year. Okay, that sounds fair. But the interesting thing is the slope, the difference in the slope for these two banks. I'll tell you the title of the paper that we wrote based on this, and the title of the paper, which is based on this, was Too Big to Innovate. Because what we see is that these big banks, they're so big that the penalty that they pay for innovating and becoming bigger and having even higher costs, because they're already beyond that optimal point, is so high that if you decrease competition a little bit, for example, as what happened during the crisis, which we show in the paper, then the effect, the negative effect on innovation for these banks is much bigger than for all these small banks. Because these small banks, if they innovate, even if they don't get a lot of market share, I'm small, you're big, you don't get that much market share, but I become a little bit bigger, and for me a little bit bigger means a lot, because then I can exploit these scale economies. But if I'm beyond the optimal point already, then I'm just basically working my way to a very obese and not very cost-effective situation. So, summing up, this we'll talk about after the break. So summing up, what we see is that whether we look at size, whether we look at product mix, or whether we look at innovativeness, we find actually relatively little evidence that this move from this small bank, this simple bank that I started with, to this big bank that was geographically diversified, offering all these different products, was much bigger, was trying to exploit all these new technologies. From a purely cost perspective, so is it helping with the bottom line? And the bottom line being not the profits, but really the cost of running a bank. There's very little evidence that suggests that we need these big banks. After the break, I want to talk a little bit more, as it says here already on the slide, about what this implies for the whole banking system. And I want to talk a little bit more about what it implies for banks in that economy that itself has changed as well. And what I'm going to end with is some suggestions about what we could do to actually improve matters.